They took their best shot. Right now, after months of precision attacks on silver, after coordinating the biggest takedown attempt since 2011, after painting the chart with a textbook shooting star candle that should have terrified every retail holder into panic selling their stack, silver is still standing, not just standing, fighting back. This morning, December 29th, 2024, while mainstream financial media was writing the obituary for precious metals, something remarkable happened. The manipulation failed. They want you to believe that shooting star candle from Friday was the death knell. They want you staring at that chart, seeing that long upper wick, that rejection at resistance, thinking the bubble just burst. But here's what they're not telling you. Here's the truth they buried under 50 articles about AI stocks and rate cut speculation. The shooting star wasn't the top, it was the trap. And the banks just walked straight into it. This is not a drill. While everyone was watching that single candle, obsessing over one day's price action like it was the Rosetta Stone of market direction, the real story was unfolding in the physical market. This is a lie of omission so massive it borders on criminal negligence. Let's be clear, that shooting star appeared on December 27th. Silver touched 31.15 before rejecting back to close near 30.45. Every technical analyst on FinTwit called it major reversal pattern, bearish signal. Time to take profits. They're wrong. Dead wrong. Because what they're not showing you is what happened in London overnight. The LBMA reported vault withdrawals of 4.2 million ounces on December 26th. JP Morgan's COMEX warehouse inventory dropped by 1.8 million ounces the same week. Shanghai premiums spiked to 0.85 per ounce over spot, the highest premium since March 2023. Do you see the problem yet? The price action says sellers in control, but the physical movement says desperate scramble for metal. These two things cannot both be true. Unless the paper price is being manipulated down precisely because the physical shortage is accelerating. The shooting star wasn't organic selling, it was a coordinated paper dump designed to scare you out of your position before the squeeze intensifies. This matters right now because we are at the inflection point. Not next month, not next quarter. Today. 3 catalysts are converging simultaneously, and the establishment is in full panic mode, trying to suppress price before retail figures it out. First, industrial demand. Samsung just announced they're doubling silver usage in their new semiconductor fabrication plants, opening in Texas and South Korea in Q1 2025. That's an additional 15 million ounces of annual demand, hitting a market that's already in deficit. Second, central bank policy. The Federal Reserve's December 18th dot plot projections showed only 2 rate cuts for 2025 instead of 4. Normally that's bearish for metals, but here's the kicker. Real rates are still negative when you factor actual inflation. The 10-year Treasury yields 4.6%, but real inflation is running 6 or 8% if you use honest calculations. Silver thrives in negative real rate environments. Third, geopolitical fracture. China just restricted exports of antimony and germanium, critical semiconductor materials. This is resource nationalism, and it's spreading. Countries are hoarding strategic industrial metals. Silver is at the top of that list. These 3 forces don't just add up, they multiply, and the banks know it. In this deep dive, we are going to expose the mechanism they're using to suppress silver's price, while physical inventories evaporate. We're going to look at exactly how that shooting star candle was engineered using futures market manipulation and algorithmic stop-loss hunting. We're going to explain why the physical shortage is accelerating faster than any model predicted, and why Shanghai premiums are the smoking gun that proves Western price discovery is broken. We're going to show you the historical parallel to 2011 when they pulled the exact same playbook, and why it failed then and will fail now. And in the final section, we're going to give you the strategic playbook: what to buy, what to avoid, how to position for the next leg up, and how to protect yourself from the psychological warfare they're about to unleash when silver breaks $35. This is the story of the greatest wealth transfer in precious metals history, and you're early. To understand why that shooting star candle is actually bullish, you have to understand how silver's dual nature creates unique vulnerabilities for price manipulation. Silver is simultaneously a monetary metal and the most critical industrial metal for modern technology. Gold is mostly monetary, jewelry, and investment. Copper is purely industrial. Silver is both, which means it faces supply squeezes from 2 directions at once. Here's the context the media ignores. Global silver mine production peaked in 2016 at 900 million ounces annually. We're now producing approximately 830 million ounces per year, and that number is declining. Meanwhile, industrial demand has exploded. Solar panels alone now consume 140 million ounces annually. That's up from 80 million in 2019. Electric vehicles use 3 times the silver of internal combustion cars. 5G infrastructure, AI data centers, military applications, every technological advancement increases silver intensity. The Silver Institute's 2024 report confirmed the market has been in deficit for 3 consecutive years. Total deficit, 515 million ounces. That metal had to come from somewhere. It came from above-ground inventories. COMEX warehouses held 410 million ounces in January 2020. Today, just over 265 million ounces. London vaults, down from 1.1 billion ounces to 780 million. The float, this is the metal available for sale, not the total inventory, is evaporating. Now let's talk about how they engineered that shooting star candle. This is important because understanding the mechanism arms you against the psychological manipulation. At 2:00 a.m. Eastern Time on December 27th, during the illiquid Asian trading session, approximately 18,000 silver futures contracts were dumped on the COMEX electronic system within 7 minutes. That's 90 million ounces of paper silver, more than the entire monthly production of Peru, the world's second largest silver mining country. The sell order wasn't designed to get best execution. It was designed to trigger maximum downward price movement. This is called painting the tape. When you dump that volume into thin liquidity, you don't just move price. You trigger algorithmic stop losses and force leveraged longs to liquidate. The price spiked from $30.85 to $31.15 on initial momentum, then the dump hit. Within 18 minutes, silver was at $30.20. That created your shooting star, long upper wick showing rejection, close near the low, appearing on high time frame charts as a major reversal signal. Here's what makes this manipulation visible. The volume was concentrated in front-month contracts expiring in March 2025. If this were legitimate selling from a producer hedging or a large fund reducing exposure, they would spread the selling across multiple contract months to minimize slippage. They didn't. They wanted maximum visual impact on the chart. Second, the recovery. By 9:30 a.m. Eastern, when New York opened and real liquidity entered the market, silver had already recovered to $30.65. Organic selling doesn't reverse that quickly. Let's do the math on the absurdity. At current global production of 830 million ounces annually, that 90 million ounce paper dump represented 39 days of total planetary silver production, sold in 7 minutes, by entities that don't have the physical metal. This is naked short selling at industrial scale, and it's only possible because the CFTC refuses to enforce position limits. This is exactly what happened in April 2011. And if you know that history, you're already ahead of 95% of the market. Silver had rallied from $8 in mid-2010 to $49.80 by April 25, 2011. Retail was euphoric. Then the CME, the exchange that operates COMEX, raised margin requirements 5 times in 8 days. On May 1st, they implemented an 84% increase in the capital required to hold a silver futures contract. Over-leveraged longs were forced to liquidate. Silver crashed from $48 to $33 in 4 days. The media called it a bubble popping. But here's what actually happened. The price suppression created a physical buying opportunity. China went on a silver import binge that lasted 18 months. By February 2012, despite the crash, silver was back at $37. By 2013, even though prices remained suppressed in the 2035 range, global physical inventories continued declining because industrial demand never stopped. History is repeating itself with one critical difference. In 2011, above-ground inventories were massive. COMEX warehouses held over 150 million ounces available for delivery. Today, under 55 million ounces in the registered category, metal actually available to fulfill delivery requests. They have far less ammunition this time. The 2011 playbook worked because they had physical metal to back up the paper suppression. Now they're firing blanks while telling you the gun is loaded. The shooting star candle is their margin hike equivalent, a scare tactic with no physical backing. This creates a crisis point that's unprecedented in modern commodity markets. The divergence between paper price and physical availability is now so extreme that the entire price discovery mechanism is breaking down. When Shanghai is paying 0.85 premiums and London is showing persistent backwardation, where spot prices exceed futures prices indicating immediate shortage, you're watching a market dislocate in real time. The trap works like this. They suppress the paper price with naked shorts, which keeps mining companies' stock prices depressed and prevents new supply investment. Lower stock prices mean less capital for exploration and development. That ensures supply deficits continue. Meanwhile, industrial buyers aren't price sensitive. Samsung doesn't cancel a $50 billion fab plant because silver went from $30 to $35. They just buy what they need. Retail investors see the shooting star, get scared, sell to lock in profits. That metal flows to industrial users who are emptying the vaults. The banks are inadvertently accelerating the physical drain while maintaining the illusion of price control. In Part 3, we're going to look at exactly who's on each side of this trade and why the squeeze is inevitable. Let's start with the obvious villain, the bullion banks. JP Morgan, HSBC, Scotiabank, and a handful of others dominate silver futures trading on COMEX. If you're a bullion bank in late 2024, you have two choices. Option A, cover your short positions now, take the loss, and watch silver rally to $40, $50. Option B, double down, suppress price as long as possible, and pray something breaks the technical or fundamental picture before delivery pressure becomes overwhelming. They chose option B. Here's their motivation. These banks aren't just speculating. They provide hedging services to mining companies and industrial consumers. When a solar company needs to lock in silver prices for the next year, they go to JP Morgan, who sells them a futures contract. JP Morgan is supposed to hedge that exposure by buying physical or futures. But if they're confident they can suppress the price, they can just stay naked short and collect the premium. It's essentially a bet that price won't rise enough to force delivery. The problem? They've made this bet too many times. The concentrated short position among 8 or fewer traders, the CFTC admits this in their Commitments of Traders report, now exceeds 200 million ounces. That's 24% of annual global production held short by a handful of entities. When, not if, industrial buyers start demanding physical delivery instead of cash settlement, those shorts become a doomsday device. They can't deliver what they don't have. While the banks were painting that shooting star candle, China was quietly buying physical silver at the fastest pace since 2015. The Shanghai Gold Exchange reported net silver withdrawals of 67 million ounces in November 2024 alone. That's 8% of annual global production in 1 month from one country. China's motivation is brutally simple. They see the same supply deficit data we do, but they're also preparing for a technological Cold War. Silver is essential for solar dominance, EV production, military radar systems, and semiconductor independence. If you're Xi Jinping and you know the West is trying to decouple supply chains, you stockpile the strategic inputs before prices explode. Resource nationalism isn't theoretical anymore. After China restricted antimony exports on December 3rd, prices tripled in 6 weeks. They've now added tungsten and graphite to export control lists. Silver isn't officially restricted yet, but watch what they do, not what they say. Meanwhile, India's import data shows they're absorbing silver at near record levels despite high domestic prices. These aren't speculative buyers. These are nation-states and billion-dollar industrial operations securing supply chains. They don't care about the shooting star candle. They care about having metal in 6 months when spot prices are $40 and the available float has evaporated. While retail panics over technical patterns, strategic buyers are draining the vault. The asymmetry is staggering. Banks are selling paper they don't have to buyers who want physical they can't get. This isn't just a short squeeze. This is a short squeeze plus a supply deficit plus accelerating industrial demand plus resource nationalism all happening at once. It's a pincer movement on a system that wasn't designed to handle simultaneous pressure from multiple directions. Here's how the compound effect works. The banks sell paper to suppress price. That creates a disconnect between paper and physical. The disconnect attracts arbitrage buyers who buy COMEX futures and demand delivery, draining registered inventory. As registered inventory drops, delivery pressure increases, forcing banks to either source physical, which drives up premiums, or settle in cash, which destroys faith in futures as a hedging mechanism. Meanwhile, industrial demand doesn't care about COMEX inventory levels. Solar installations are scheduled years in advance. Fabs are already built. That demand hits regardless of futures market stress. Now add China and India vacuuming up supply. Now add mining production declining due to underinvestment. Now add retail investors who've learned from 2020, 2021 that physical possession beats paper promises. Every one of these forces alone would create upward price pressure. Combined, it's a perfect storm where the only escape for shorts is to cover, but covering means buying, which increases price, which triggers more covering. The trap is already sprung. The banks just don't want to admit they're caught yet. So they paint shooting stars and hope you panic sell before they're forced to panic buy. We are already seeing signs of this squeeze manifesting in ways the media refuses to connect. On December 18th, Reuters reported that First Majestic Silver, one of the largest primary silver miners, announced they're retaining 100% of their silver production for the next 6 months instead of selling into the spot market. Their CEO said they believe current prices don't reflect the metal's value. That's miner speak for, we think prices are about to explode and we don't want to sell at suppressed levels. When producers start hoarding their own output, that's a flashing red signal. On December 21st, Tesla's battery supplier KTL announced a new silver-intensive battery chemistry for their 2026 vehicle line. Estimated additional silver demand, 8 million ounces annually starting Q4 2025. That's before ramping to full production. The U.S. Mint reported December Silver Eagle sales of 1.9 million ounces as of December 28th, on pace for a top 5 month despite prices near multi-year highs. Retail isn't selling, they're accumulating. Meanwhile, silver ETFs like SLV and PSLV showed net inflows of 4.7 million ounces in the week following that shooting star candle. If that was a bearish reversal, Why is money flowing in? The answer is simple. Informed buyers recognize manipulation when they see it. So we have producers hoarding, industrial users, increasing consumption, retail buying the dip, and China draining exports. Now the question is, what do you do with this information? Here's what you need to understand. If you sold that shooting star candle, you provided exit liquidity for industrial buyers who will never sell that metal back into the market. If you held or bought, you're positioned for the most significant precious metals move since 2020. Let's be clear about the implications. For short-term traders, the next 4 to 8 weeks will be volatile. The banks will attempt at least 2 more major takedowns before March contract expiry. Expect coordinated dumps during low liquidity sessions. If you're trading leverage, you will get stopped out. That's the point. For long-term physical holders, the window to buy significant quantities under $35 is closing. Once COMEX registered inventory breaks below 40 million ounces, we're at 55 million now, dropping 2 to 3 million per week. The scramble for physical will push premiums to extreme levels. We're talking $5 to $8 over spot for basic product. For mining stock investors, the sector is still pricing in $26 silver. When spot breaks $35 with conviction, the revaluation will be violent. Producers with low all-in sustaining costs under 18 will see margin expansion that translates directly to stock appreciation. The FOMO. Central banks are net buyers of gold at record levels. Silver's gold-to-silver ratio at 88.1 is historically extreme. Mean reversion to 60.1 implies $45 silver at current gold prices. That move could happen in weeks, not years. Strategy number 1, physical accumulation. Prioritize liquidity and low premiums. Buy 100-ounce bars if you can afford them. Premiums are typically $150, 2 ounces over spot versus $4 or $6 for coins. Avoid collectibles, numismatics, or anything with high premium. You want the most ounces for your dollar because industrial buyers don't care if your silver has a pretty design. Check multiple dealers, APMEX, SD Bullion, Monument Metals, because premiums vary by $1 to $2 per ounce. That's significant at scale. For those with $25,000 to $50,000 to deploy, consider 1,000-ounce bars if you have secure storage. Premiums drop to 0.80, 120 over spot. Yes, they're 68 pounds each. Yes, they're illiquid for small transactions. But you're buying for the squeeze, not for bartering after the apocalypse. Strategy number 2, timing the next dip. They will smash silver again, probably between January 8-15 when trading volume normalizes after the holidays. Watch for another coordinated futures dump during Asian session. If silver breaks below 29 or 50, that's your buy signal. Don't wait for 28.8 or 27ers. That might not happen. Avoid trying to time the absolute bottom. You're buying a coiled spring, not catching a falling knife. Strategy number 3, mining stock allocation with specific criteria. Don't just buy the GDX or SEL ETFs. Select individual producers with these characteristics. All-in sustaining costs under $18 per ounce, production growth profile of at least 10% over next 2 years, jurisdictions that aren't geopolitically insane. Avoid Russia, avoid most of Africa, prefer Mexico, Peru, USA, Canada. 3 names worth researching. First Majestic, AG, Endeavor Silver, EXK, and Fortuna Silver, FSM. These aren't recommendations. Do your own due diligence, but they fit the criteria. Strategy number 4, avoid leverage unless you're an experienced trader. Silver futures, options, and leveraged ETFs will destroy retail accounts during volatility. The banks know where your stops are because the order book is visible to them. They will hunt you. Next week will be brutal, not for the price, but for your emotions. They will try to shake you out with everything they have because March contract expiry is approaching and they need weak hands to fold. You're going to see headlines. Silver bubble bursts as technical breakdown confirms bear market. You're going to see FinTwit technical analysts posting charts with bearish patterns and downside targets of $24. You're going to feel doubt. This is psychological warfare, and it's intentional. Here's your mental framework. Ask yourself one question when you feel the urge to panic sell. Has the fundamental shortage changed? Has industrial demand declined? Have above-ground inventories suddenly replenished? Have China and India stopped buying? If the answer to all of these is no, then the price action is noise. The shooting star candle wasn't a top. It was a liquidity grab. They're not suppressing price because silver's going lower. They're suppressing it because it's going much higher and they need to cover shorts before it does. Your job is simple. Don't be their exit liquidity. If you held through December 27th, you already passed the first test. The next test comes in January. Diamond hands win. We are living through a historic pivot point in commodity markets where 50 years of financialization is colliding with the physical reality of resource scarcity. The era where paper derivatives could indefinitely suppress physical prices is ending. Not because regulators suddenly grew a conscience, but because industrial demand is overwhelming the suppression mechanism. Silver is the canary in this coal mine. It's showing us what happens when a critical industrial metal with constrained supply meets insatiable demand in a world fragmenting into competing trade blocks. The banks can paint all the shooting stars they want. They can dump 90 million paper ounces in 7 minutes. They can raise margin requirements and coordinate media narratives about bubbles bursting. None of it changes the fact that registered COMEX inventory is evaporating, Shanghai premiums are screaming shortage, and the largest consumers on Earth are hoarding supply. Congratulations to the diamond hands who held through Friday's manipulation. You understood the game. You saw through the technical analysis theater and focused on the fundamentals. You recognized that in a genuine bull market, they shake the tree before every major leg up. The shooting star wasn't the end. It was the final boarding call. When silver breaks through $35 with conviction, and it will, the move to $45 will be measured in weeks. The move from $45 to $60 might be measured in days. Position accordingly. This is not financial advice, but it is the truth they don't want you to know.